Welcome to Series 7. I'm Michael Quinlan. Each tape is designed to improve your understanding of a topic that is essential to your success on the Series 7 exam. Throughout this program, I encourage you to use the video technology available to you. Pause, rewind, and slow me down when you want to review more carefully. As you've probably discovered, studying this material takes a lot of concentration, so you should take breaks when you feel the need. Allow about 2 hours to complete this tape. If you have questions on the topics discussed in this program, contact your local STC branch. You can find the telephone number in your study materials. If you would like additional materials, call 1-800-STC-1223. We have a lot of material to cover, so let's get started. Now, as we've said, the subject of today's show is markets and regulation. When you think of a market, what comes to mind? Well, it's a place where people can buy things, and that's true in the securities industry as well. A market is the process by which people buy and sell securities. So, of course, it will be important for us to understand how that works. Why regulation, though? Why should we bring this in at this point? Well, regulation is extremely important in the way that markets function in the securities industry. It has a lot to do, for example, with what you can do as a registered representative on a day-to-day basis. So we have to understand what these regulations are and who the regulators themselves are. When we think of regulation, though, in the securities industry in this country, we need to remember that it's a dual system of regulation. Both states and the federal government regulate your activity. So when you buy and sell securities, you must remember both types of regulation. State regulations are nicknamed blue sky laws, and they will not really be an important element on the Series 7 exam. So we're going to be focusing on the federal regulations on the Series 7 test. It's important then for us to understand what these federal regulations are, since they are so important on the exam. Where do they come from? Who enforces them? Well, no matter who enforces them, one thing to remember is that all of these federal rules and regulations somehow get their start with Congress. And there are several agencies that, once these laws are passed, are responsible for enforcing the laws on a day-to-day basis. For example, tax regulations are the area covered by IRS rules, so we'll need to be familiar with those to understand the securities industry. The Federal Reserve Board, or as we'll call them, the FRB, has an important role to play. For example, they regulate credit, as in margin accounts, and we'll be studying margin accounts in a later program. But for our purposes, the most important regulator will be the Securities and Exchange Commission. The SEC has the main responsibility for enforcing securities laws. Now, when we're looking at the SEC, we want to ask the question, well, whom are they dealing with? The SEC regulates, for example, issuers of securities, those corporations who are selling stocks and bonds to the public. In addition, they regulate the activities of investors buying and selling securities in the market through, for example, insider trading rules, which we'll discuss later. But for our purposes, one of their most important functions is to regulate the activity of the brokerage firms in the industry and all the registered reps who work for those broker-dealers. But here we have a problem. The SEC does not actually have a staff that's large enough to fulfill all the functions that they have. To regulate the thousands of brokerage firms that are out there and the hundreds of thousands of reps working day to day in the industry. So what the SEC has done is to set up an arrangement with the brokerage industry itself. The brokerage industry has set up their own regulatory organizations, or SROs. Now, these SROs do the day-to-day policing of the activity of dealers under the oversight of the SEC. So we should be familiar with some of the main self-regulatory organizations. These organizations would include, for example, the New York Stock Exchange, which we'll call the NYSE. Now, many firms are members of this organization, and that's their SRO. And mainly, the National Association of Security Dealers, or NASD, regulates the over-the-counter market. The Municipal Securities Rulemaking Board, or MSRB, regulates the municipal market, and many important options rules are the subject of the Chicago Board Options Exchange. So you'll need to know these federal rules and rules of the self-regulatory organizations we mentioned as well. Now, where shall we start when looking at regulation? Well, probably a good place to start would be to talk about how securities get into the market in the first place. And when we think about securities going into the market, why are they there? Well, securities are used by corporations to raise capital. Corporations then use this capital for a wide variety of purposes, For example, they might want to construct a new project or plant or factory. They could also use this capital to purchase new equipment. Another purpose, research and development, often needs large amounts of capital. We'd also need a lot of funds in order to take over or merge with another company. And as well, a company might want to do some internal financial restructuring to improve the status of its balance sheet. Now, there are a variety of ways in which the corporation might acquire the large amount of capital that it's looking for. For example, the company might go to a local bank and attempt to borrow money from the bank. The problem with that approach is that many of those loans are fairly short-termed, and often corporations, for the purposes that we just mentioned, would like to have this capital and invest it over a much longer period of time. So usually a corporation would obtain this type of long-term capital by selling new securities to the public. Now, these securities are sold with the idea of the public providing the capital needed by the issuer. In return, the public receives the security that it hopes to earn an investment return over a long period of time. Federal, state, and local governments also use this method of raising capital as well. Now, this process has been going on in our economy for hundreds of years. But prior to 1933, there was no specific federal regulation of this process. A business that wanted to sell stocks or bonds to the public simply went ahead and did so to raise capital. But this created certain problems for investors. Occasionally, investors would buy securities that were riskier than were originally led to believe. They didn't have enough information to know that there was a problem. So Congress decided to protect investors by passing the Securities Act of 1933. The philosophy of this law is full disclosure. That is, the issuer is required to provide investors all relevant, that is, all material information about the issue. Full disclosure then means that before the issuer can sell securities to the public, it must file what is called a registration statement with the SEC. Now, this document contains all relevant information that any reasonable investor might want to know about this particular security, and from this information, the investor can make an intelligent decision about whether to invest in the security or not. Now, before we talk about the registration process in more detail, we need to bring in another player into the picture. Now, so far, we have the issuer selling securities to the public. And although after registration, an issuer could sell its securities directly to the public itself if it chose to do so, most corporations, if we think about their officers and employees, they're busy running the business and trying to earn a profit. They really don't have the time or expertise to do the sale of the securities to the public themselves. So this is where the service of a brokerage firm would come in. The brokerage firm would act as a middleman in the transaction, buying securities from the issuer and then reselling them to the public to raise capital for the issuer. When a broker-dealer acts in this way, it would be called an underwriter. Now, the traditional way that underwriting would work is that the broker-dealer literally would buy the entire issue of securities from the issuer, paying the issuer a set amount, and then turn around and resell those securities to the public. The difference between the sale price to the public and the purchase price from the issuer would be the profit to the broker-dealer. Now, this approach is known as a firm commitment underwriting. Now, firm commitment underwriting does involve some risk because there is a chance that when we turn around and resell those securities to the public will not want to pay the price that will earn a profit for the syndicate. The syndicate might in fact lose money in this case. And we can imagine that there might be cases where the syndicate might not want to do a firm commitment underwriting. Perhaps it's a new company, they have no track record, and we don't know whether the public will be receptive to the new issue or not. Or perhaps it's a company that's already in financial trouble, so it might be difficult to get the security sold. In such a situation, though, we can take another approach to underwriting securities, another approach that the underwriter might also use to sell securities for the issuer to the public, attempting to sell as many as possible, but if any of the securities are unsold, these securities are returned to the issuer. The underwriter, or broker-dealer, has no obligation to pay for unsold shares. This style of underwriting is called a best efforts underwriting. You should remember then that there are two main styles of underwriting. The firm commitment underwriting, in which we're taking a risk by literally buying the securities from the issuer and reselling them to the public, and best efforts underwriting, where we're kind of doing the job on consignment. Now, we'll sell what we can, but we're not liable for any unsold shares. Now, once we know the purposes of the underwriting and how the broker-dealer fits into the picture, we should go back and look at the SEC regulations for the process of registering securities. This process divides an underwriting into three specific phases. The first phase is the pre-registration period. During this time, the issuer prepares the registration documents to be filed with the SEC. Now, the underwriter also becomes involved at this point, helping the issuer prepare documents. In fact, they're required to check out the information that the issuer puts in those documents. This process is called due diligence. Registered reps, though, have to be careful not to reveal any of this information to their customers during the pre-registration period, because so far it hasn't been revealed to the public. Now, once the documents have been prepared, we then file them with the SEC, and the date that the issuer files this registration statement with the SEC is called the filing date. That would end the pre-registration period and begin the second phase called the cooling off period. Now, sometimes this is called the waiting or quiet period. Now, in theory, this is supposed to be 20 days long. The SEC then gets a chance to review the registration statement during that period of time. However, problems can arise. If the SEC finds problems with the registration statement, something that's unclear, something that is perhaps omitted that they think should be there, they will send the issuer a deficiency letter, and the issuer then has to fix the registration statement before the offering can proceed. Now, what are the underwriters doing during this period of time? Well, the underwriters are now allowed to talk to the potential clients during this phase because the registration statement is now public information. In fact, they can give their customers a summary of this registration statement known as the prospectus. However, the prospectus at this time is only a preliminary version because we might have to change it due to SEC required amendments. So it's known during this phase as the red herring. The preliminary prospectus is the red herring. Now, it's important, though, that we only talk to customers during this period of time. We're not allowed to actually sell securities to our customers during this phase. We can only take what are known as indications of interest, indications that customers might want to buy the new issue when it's actually available. Now, once the SEC has finished their review of the registration statement, they notify the issuer that the registration statement will be effective on a particular date. Now, this will be known as the effective date. On or after the effective date, we may now sell the securities to the public. So this final phase would be known as the post-effective period, or the post-registration period. We can now actually sell securities to the public, and we hope, of course, that we do that quickly. The issuer receives their money, and the syndicate earns their profit on the transaction. Now, since we're very concerned about the role of the broker-dealer in this whole process, what we'd like to do is to take a look at the financial arrangements for the syndicate. And by the way, syndicate means a group of broker-dealers who act together to do the underwriting. Most underwritings are not done by a single broker-dealer because of the risk involved. So we're going to have several broker-dealers work together in a syndicate. So let's take a look at a simple syndicate. And our syndicate will be composed of 3 broker-dealers. Now the syndicate is usually started by one of the broker-dealers who act as what we call the manager or lead underwriter. They're usually the broker-dealers who actually found the deal in the first place. Then they invite other broker-dealers to join the syndicate. For example, broker-dealer B and broker-dealer C are syndicate members. As a syndicate member, they would want to know how the syndicate divides its proceeds and what their responsibility is. So we'll describe what this division might be. Now, here in our example, we're going to assume that the public offering price, that is the price we're going to sell these securities to the public for, is $10. A part of this, of course, will go to the issuer. In fact, most of this will go to the issuer, and that part we're going to assume is $9.20, just to take a look at an example. And notice in this case, that leaves 80 cents for the syndicate profit. The syndicate's profit would be known as the spread. Now, the spread is the profit that we have to divide among all of the syndicate members, but we should take a look at the way that spread is divided even further and who in the syndicate gets what part of the spread. So we're going to look at an example and assume that we have an offering for 100,000 shares of stock. The manager is the one who decided how these shares will be split up among the syndicate members. And let's assume that the manager allocates 50,000 shares to itself. Broker-dealer B receives 30,000 shares to sell, and broker-dealer C is responsible for 20,000 shares. That's the responsibility of each of the syndicate members, but it turns out they may not actually sell all of these shares to their own customers. The manager might allow some other broker-dealers not in the syndicate to participate in the sale as well. These additional broker-dealers are known as members of the selling group. So, for example, Here we assume that broker-dealer X is in the selling group, and the manager might allow broker-dealer X, for example, to sell 7,500 shares of the 30,000 that were allocated to broker-dealer B. And once we know that this is the way that the syndicate allocates its shares, how is the spread then divided up among the various underwriters? Now remember that we have an 80-cent spread to split up. Well, first off, usually part of the spread from every share sold goes to the manager as the manager's fee for finding the deal and setting up the syndicate. Now that's true no matter who sells the shares. The remaining part is divided further, the largest portion being the concession. In our example, we're going to assume that it's 50 cents. Whichever broker sold the shares will earn the concession. The remainder of the spread then in our example would be 20 cents, is called the underwriting fee. Now this is earned by whichever broker-dealer actually assumed the risk that the shares might not be sold. So given this breakdown, how much would X, a member of the selling group, earn if that firm actually sold one of the new shares? Well, of course, 10 cents of the spread still goes to A for being the manager, but X did make the sale, so X received the concession of 50 cents. If X didn't sell those shares, who was liable for them? Broker-dealer B would be. So broker-dealer B will retain 20 cents, the underwriting fee, even though the shares were actually sold by someone else. Now, what happened to the 22,500 shares that B retained for its own customers? Well, B, of course, still has to give up 10 cents to the manager as the manager's fee. But in this case, B both sold the shares and earned the concession and took the risk on those shares, and so receives the underwriting fee. So B would earn 70 of 80 cents in this case. Finally, what does A earn for selling shares? Well, A is the manager. A would earn the concession for selling, and A would earn the underwriting fee for taking the risk on those shares. So A would earn the entire 80 cents on that particular situation. So it's important to understand then how the underwriting fee would be split up among the members of the syndicate. Now, investors who buy new issues, as we mentioned, are participating in the new issue market, which we'll call the primary market, the market for new issues of securities. And notice that we have a public offering price of $10 per share. Once that has been set, the syndicate members must sell all shares to the public at that POP. They can't sell some for more and some for less. They all must go for 10. However, some investors who purchase these shares as a new issue will quickly turn around and resell these shares to other investors, and this will be known as the secondary market. Now, the price in the secondary market could be whatever investors in that market think they are worth. So, for example, one thing that we could see is that the stock trading in the secondary market could drop to, for example, $9.25 per share, less than the POP. Now, this could be a real problem for the syndicate. Now, remember, as a syndicate member, you're trying to sell shares at $10 per share to the public, but the investors can obtain the same shares in the secondary market for $9.25. So you're going to have a very hard time selling your shares at $10. Now, what the syndicate could do in this situation is a technique to help support the price to make the offering more successful. They can actually buy back stock in the secondary market, and this process will be known as stabilization. Now, stabilization really is a technique that is manipulative, and most manipulative techniques are not allowed in the secondary market. But in this case, the SEC makes an exception. The syndicate can stabilize if it follows strict SEC rules as to how it goes about this and engages in the process. Now, we've been focusing on situations where the securities had to go through the SEC registration process, but there are several types of situations where this does not need to be done. The securities sold to the public but don't have to be registered. These securities would be known as exempt securities. So it's one of the common problems that you run into at looking at regulation on the exam. Many rules have exceptions, and you need to know these exceptions. So, for example, securities issued by the government, agencies of the U.S. government, by municipalities, and municipal bonds are exempt. And of course, in a later program, we'll discuss municipal bonds in much more detail. Securities issued by banks and nonprofit organizations are also exempt from registration, as is commercial paper, short-term corporate debt. Regulation A, used for small offerings, is also an exemption, as are intrastate offerings, securities that are just sold within a state. And one of the most important exemptions that we want to focus on in a little more detail is the private placement exemption. Now, we should understand the private placement exemption and some of its features. First of all, what is private placement? Well, if we look at the registration process again, we can see that initially what we wanted to have happen is to have the security sold to the public. So if we look at what a private placement is, it must be in a situation in which the securities are not being sold to the public. Instead, securities are being sold to some private party. Here would be the normal offering. Now, if we don't sell to the public, if instead we sell to a private party, then the securities, in theory, shouldn't need registration. So the private party is going to be involved in this particular transaction. If the securities are sold to a private party, we don't need to register them with the SEC. So it's this private sale that makes this particular offer exempt. But what do we mean by a private transaction? If we sell to just a couple investors, that seem like a pretty private transaction. But what if we sell to 10 investors or 50 investors or maybe 50 people that we know? You see, we have to have some rules here dividing what is a public and private transaction. So we'll look at the rules that govern what a private placement is, and we'll be familiar with some of the basic rules that are involved. So let's take a look at this regulation called Regulation D that governs what a private placement is. First of all, one of the key rules is that there can be no general solicitation. And what this means is we can't just randomly call the general public, no cold calling. We can only deal with clients that you are familiar with, that you think are qualified to buy the private issue. Next, the stock that you're selling must be restricted, meaning that it cannot be sold in the normal manner. Now, this condition is designed to prevent the following problem. If we sell securities to a private party and simply let them do whatever they wish, what they would normally do with these securities, what they might do rather quickly, is to just turn around and resell those issues to the public. But the public doesn't have any disclosure information with which to evaluate this issue. Now remember, we didn't register these securities. So to prevent this problem and to protect the public, the SEC prevents this resale. So that is the reason for the restriction. Placing a legend on the stock saying that this sale is restricted usually does this. Now there is also a limit on the number of purchasers that can be involved. The issuer can sell to no more than 35 non-accredited investors. There's another category, an investor called accredited investor, and there is no limit on the number of investors in that category. And these are basically people who have some special characteristic. For example, people who are insiders within the company, institutional investors who are considered sophisticated, and wealthy investors who have the means to bear the risks which are involved. Now, one of the problems, though, that face investors who own this restricted stock is if it's difficult to resell the stock in the normal manner. How can we ever earn a profit on our investment? Well, what we could do, for example, is take the unregistered stock, the privately placed stock, and register it with the SEC using the normal registration process, filing a registration statement, making a prospectus available, et cetera, et cetera. But you can imagine that for most investors, that's way too difficult and expensive to do. So most investors would rely on what is called Rule 144 to sell these securities. And we want to make a point that Rule 144 applies to two different kinds of securities. Now, the restricted securities that we were just talking about were purchased through a private placement where the issuer sells to a private party. But there is a second category of securities that are included in the rule as well. They are called controlled stock. Now, there are securities purchased through the open market by what we call a control person. This is a person who has a certain influence with the issuer, like a corporate officer or a member of the board of directors. So this person also has to watch for Rule 144 when selling this particular stock in the open market. So both investors then have to satisfy these conditions before restricted or controlled stock can be sold, the conditions that are held under Rule 144. So let's take a look at some of the conditions that would apply here. For example, a one-year holding period applies. Now, this is for restricted stock only. If you own control stock, you're on the board of directors or a controlling person, and you don't need to worry about the one-year period. But the rest of the rules would apply to both types. There has to be public information available about the issuer, things like financial statements available. Now, there is a limit on the amount of shares you can sell during any 90-day period. There's a limit on the way these securities can be resold by your broker-dealer. And of course, like most federal rules, you have to file a form called Form 144. Now, up to this point in our discussion, we've been talking about what we call the primary market, cases where we have a new issue being sold to the public. Now, if a public investor buys one of these new issues, of course they hope to receive a return on their investment. Eventually, they will probably resell their investment, especially if it's an investment like common stock. But how do they do that? Now, notice that the issuer has taken the proceeds from the new issue and invested it in the corporation for a new building, research and development, or whatever, so they are not about to buy back our stock to cash us out. So what we have to do is take that stock as an investor and resell it to another investor. This process is one of investor reselling securities to another investor, would be known as the secondary market. Now, an investor in the secondary market could go out and locate another investor directly, right? You have to sell some stock and you have to pick up the phone and call your next door neighbor to see if they'd like to buy the stock from you. But of course, most investors don't do that. They don't have the time, the expertise, or the method of finding that other investor. So most investors use the services of a brokerage firm to arrange trades in the secondary market. So the buyer goes to a broker-dealer to arrange for the purchase, and the seller goes to a broker-dealer to arrange for the sale. It is usually the two broker-dealers who arrange for the trade for their customers. So the broker-to-broker transaction sets up the trade. So here we've agreed on the price of the security and the number of shares to be exchanged. But the actual exchange of money and securities occurs several days after the trade has been arranged. And we would refer to this as the settlement date. Once the exchange of money and securities occurs between the two broker-dealers, they're of course paid a commission for the services that they perform for us. Now, this type of transaction is known as a broker trade or an agent trade. Now, these two terms are interchangeable. Now, many securities transactions in the secondary market are done this way. So notice the broker-dealer is really representing you in the market and trying to arrange a deal for your benefit. But there are other ways that we can arrange transactions in the secondary market as well. For example, let's assume an investor wants to sell some stock. But this time the broker-dealer will actually buy the stock from the customer and place the stock in its own inventory using its own money. When a broker-dealer engages in this transaction, it is said to be acting as a dealer or principal. Those two terms can be used interchangeably. Later on, the dealer hopes to resell those securities that are in its inventory at a profit. Now, this resale could be done in a couple of ways. We could resell the securities to another broker-dealer, which would be like a wholesale transaction, which we would call an interdealer trade. Or we could resell the securities to another regular investor. Sometimes we'll call that a retail transaction. So both types of transactions might eventually occur. Now, understanding how dealers work is most important. So let's take the case of broker-dealer C having an inventory of a specific stock, in this case, XYZ stock. Now we're going to assume that this broker-dealer would like to sell XYZ stock. Broker-dealer C is willing to buy, so a seller can always sell to broker-dealer C XYZ stock. In addition, if another broker-dealer would like to buy XYZ stock, C is willing to sell to the other broker-dealer. So notice this particular broker-dealer is always willing to buy or sell XYZ stock. We could call this brokerage firm a market maker in this particular stock. And so you can specialize in the particular stock in which you think that you can make money by choosing to make a market in that stock. Now, the price at which C is willing to buy from another broker-dealer would be the broker-dealer price. Well, let's assume in this case it's $32 per share. The price at which C is willing to sell to another broker-dealer would be C's asked price, and let's say in this case that it's $32.50. So let's think of broker-dealer C asking $32.50 per share if you want to buy that stock. So that is known as C's quote. It is often stated at $32 to $32.50. Now, market makers are an important part to the securities industry. They provide what we call liquidity. That is the ability to buy and sell securities quickly on short notice without a loss in value on the securities. So the more market makers there are in the specific security, the easier it will be for us to buy and sell the security when we wish to do so. Now, we talked about how individual broker-dealers operate in the secondary market, but how do broker-dealers actually locate one another so they can set up the trades that we mentioned in the first place? And how do they decide what an appropriate price should be for those transactions? So there are two major methods for doing this. A method or a process for buying and selling securities is called a market. And the two major types would be exchange markets and over-the-counter markets. An exchange market is an actual central location where trades are done, usually on the physical trading floor. where there is an over-the-counter market is a more informal telecommunications market that is set up between broker-dealers at various locations around the country. Now we're going to discuss the exchange market first. So what we're going to do is assume that a customer has given an order to buy or sell a specific security. The type of security that we're going to talk about is an exchange-listed security. This means that this specific security that we want to buy or sell has been admitted to trading privileges on the floor of the exchange. Only listed stocks can be traded on the floor. Once the broker-dealer has received the order from the customer, the order then is sent on within the brokerage firm to the department called the wire room or the order room. They have to decide where to send this order for execution. If this is an exchange-listed stock, like we have here, the order would then be sent to the floor of the stock exchange to a booth on the floor set up to receive orders for that particular firm, the communications booth. Now, this booth also receives orders from other branches of the same firm that might be located at various locations around the country. A clerk who's located at the booth would then take that order out onto the floor and try to locate a person called the floor broker. Now, the floor broker is associated with this member brokerage firm, but this person has a membership or a seat with the privilege to trade on the floor of the exchange. Only members can trade on the floor of the exchange. Now, there are a lot of other members trading on the floor of the exchange as well, and since we can only trade with those other members, we have to locate someone else to buy the specific stock that we're interested in selling, XYZ stock. Now, how do we do that? Do we just randomly walk around hoping to bump into someone who wants to make a trade with us? No. What we have to do is a very efficient process, is to go to a specific spot on the floor. We'll walk over to that spot, and that particular spot is called a trading post, or just the post. Each stock traded on the floor is assigned to a specific post. What we hope to find there is a group of other floor brokers who are interested in buying or selling that specific stock. And we would refer to those people as the trading crowd. And we hope then to do the transaction in the trading crowd. Now here we have to talk about how this arrangement actually occurs. Now that we have located that group interested in buying or selling that specific stock, how do we set up the deal with them? Well, what we're not allowed to do by the rules of the exchange is to walk over to perhaps a person that we know on the floor and arrange a one-on-one private deal with them. Because how do we know if what we set up, that deal that someone else in the trading crowd might have provided a better deal for our customers? Well, we're not sure. So the exchange requires that all purchases and sales, bids and offers, and pricing must be announced openly in the trading crowd. That is known as an open outcry system. So let's go through an example to show how this process works. Let's assume that our customer has given us a market order to buy 100 shares of XYZ stock. Now that means that we're supposed to buy the stock as fast as possible at the best currently available price. So that means we'll go over to that post for that particular security and listen. At the post, the buyers are announcing prices that they're willing to pay. Now, these are called bids. So for example, a buying broker might say 51 for 2, meaning I will pay $51 per share for up to 200 shares of that stock. Now sellers must also announce prices that they are willing to accept, called offers. For example, a selling broker might shout 3 at 51.5, meaning I have 300 shares that I'm willing to sell at $51.50. Now, there may be several bids and offers in the trading crowd at one time, but there is only one bid and one offer that matter. That's the highest bid and the lowest offer. This gives us the quote for that particular security. In this case, 51 to 51.5, 2 by 3. This means that some broker will buy 200 shares at 51, and another broker will sell 300 shares at 51.50. So let's say that our floor broker approaches the trading crowd with a market order to buy. Again, our broker now has to buy that stock at the best price currently available. So since we are interested in buying, we would be interested in the prices that the sellers are offering for the stock. The floor broker then would accept the stock being offered at $51.50 by saying, for example, I'll take 100. At that point, a trade has been done. So in theory, what we've done is located the best available price for our customer. Because all the prices at which people are willing to buy or sell is represented in the trading crowd. So again, in theory, this gives us the best deal that is available. But we do have a problem. It turns out that the number of stocks traded on the floor, that is the number of stocks listed, is far greater than the number of brokers that are trading on the floor. So if you think about the numbers that are involved, When you walk up to a post, there might not be a trading crowd by which you could do a transaction. So let's go through what might happen there. For example, let's suppose that we again approach the post with our order, buy 100 at the market, but there might not be a trading crowd at that point. So are we stuck? Well, no, because it turns out that there will always be at least one person at that post, the specialist for that stock. This is another member of the exchange who is always willing to buy or sell the stock that we are interested in. Now, this specialist has a dual role on the exchange. When we do trades with them, they act both as a broker and as a dealer. So we walk up, they give us a quote. But this specialist is responsible for a few things. First of all, they are responsible for keeping what is known as the book for that stock, so that orders left by floor brokers can be left with the floor specialist and executed at some later time. In keeping the book, then, the specialist acts as a broker, in that the specialist executes orders for other people and receives a fee for doing this. However, in addition to doing this, the specialist also trades stocks for his or her own account out of inventory. And in this role, the specialist acts as a dealer. Now, in acting as a dealer, the specialist cannot disrupt the market. That is, they can't take special advantage of their situation to buy or sell at prices that would be to a disadvantage to the rest of the orders presented in the trading crowd. They do have a responsibility, in fact, to keep what is called a fair and orderly market. For example, if we have a lot of buyers and no sellers, then the specialist must step up and sell stocks. On the other hand, if we have a lot of sellers and no buyers, the specialist must step up and buy stock when no one else is willing to do so. So in return for their privileged position on the floor, they do have this responsibility for keeping what is called a fair and orderly market. Now, we should take a look at some of the types of orders that the specialist will accept for the book, because there may be questions that you will have to address in this particular area. So let's take a look again at an example. Suppose a floor broker approaches the post with an order from a customer to buy 100 ABC at this time, but no more than $50 per share. Now, we would refer to this as a limit order because the customer is putting a limit on what he or she is willing to pay. The specialist tells the floor broker that the current quote for the stock is $51 to $51.50. Now, that means we could buy at the ask price right now of $51.50, but that's not acceptable to us since they cannot execute this order immediately. The floor broker would leave the order with the specialist. And later, if the stock falls to 50 or less, then the specialist will execute the order for our customer. Now, there may be several different types of problems like this that you may encounter. So we want to set up a diagram to describe these various types of orders and how they fit into the market. Now, on our diagram, what we're going to do is divide the diagram into two halves, left and right. Buy orders will be on the left, and orders to sell will be on the right. Now, this level represents the price of the stock, so the middle line represents the current market value of the stock. So, for example, one may apply that diagram that we looked at so far is to remember that in our example, we could buy stock right now at $51.50, but we didn't want to pay that. We wanted to buy stock down here at 50. So we would say that the buy limit order, we would be executed at a price that's lower than the current market price of the stock. Therefore, we would say that a buy limit order is below the market. Now, this can help us put the price of the order in perspective to the relationship between the price of the order and the current market price of the stock. Now, to understand how these orders work, we need to look at an example. So now let's suppose that we have just entered an order to buy 100 shares of ABC stock at $50 per share. Now let's just think for a minute at what we're saying. We want to buy some stock, ABC, but we don't want to pay more than $50 per share. So where is the stock probably in the market right now? Well, it's probably right up here, which is a little high right now. Now, we don't want to pay that much. We want the stock to come down. So now let's suppose that a series of transactions in ABC stock occurs, and we might see this, for example, come across the ticker tape. Now, we're trying to figure out when our order will be executed. Remember, we will only accept an execution if the stock is at or below 50. So these first transactions are not acceptable. The first transaction that meets our conditions is the price at $49.89. So we would have an execution at this particular point. But there's an assumption that we need to make clear at this particular point. If you enter an order that you would like to buy 100 ABC at 50, and then you see a price come across the tape that would fill your order, sometimes that doesn't necessarily mean that the stock was actually purchased for your account. For example, Someone else might have entered the same exact order before you, and of course, they would be first in line. Any stock available would fill their order, and then you would be next in line, and we call this process stock ahead. But in the example that we're going to look at, we're going to assume that there is no stock ahead. You're first in line to receive the order. Now, in the situation that you've been looking at, we've been looking at buying stock, but we can have a similar situation on the other side of the market if we would like to sell stock. So again, in this situation, we'll assume that a floor broker approaches the post with an order to sell 100 shares at $52.50. So this investor is saying, I want to sell stock, but I want to receive at least $52.50. Now notice at what price can we sell stock right now? Well, we can sell at the bid price of $51, but that is not high enough for our customer. So again, we would leave this order with the specialist who would execute it again later on. So where in our diagram would a sell limit order appear? Well, in this case, we want our stock to sell for more than we can currently get in the open market, so the stock has to come up. So we would say a sell limit order is entered above the current market value of the stock. And the diagram tells us that the stock would have to rise before we could receive an execution of our order. So let's look at an example to see how this might work. Suppose we want to sell stock at $52.50. So again, remember, what this says is, you should be able to repeat this to yourself. I want to sell stock, but I don't want to get any less than $52.50. I must have $52.50 or more. Then a series of trades occurs after our order is entered. Now again, we won't accept an execution until it's at least this high. So the first price that would satisfy our condition would be $52.63 in this particular case. Now one way to think of any of these limit orders is as wishful thinking. We hope we can sell stock, or we hope we can buy stock for a price acceptable to us. Now, you want to buy some stock, but you don't want to pay as much as the market demands right now. So you hope it will fall. You want to sell stock, but you want to get more than the market is willing to pay, so you hope that it will rise. So if we think about that way of visualizing market orders, we can place them in the right perspective in relation to the current market price of the stock. Limit orders are very helpful because they can sometimes give us the transaction that is at a better price than we get right now. But limit orders don't do everything that we would like an order to do. Sometimes we have to change the nature of the order to get it to work exactly the way that we would like. So let's take a situation that might illustrate that. Suppose an investor currently owns stock purchased at $86 per share. If someone owns stock, we would usually use the term long to refer to their position. Long simply means that you own that stock. You're invested $86 per share, or $8,600 for a round lot altogether, a significant investment. Of course, you hope the stock goes up, but the stock might fall, and in that case, you might suffer a significant loss. So let's say that you're prepared to hang on to that stock as long as the stock doesn't fall by more than 6 points. At that point, if it fell to 80, we're going to assume that you would want to sell that stock and cut your loss. What kind of order would allow us to leave those directions with our broker or with the specialist? Sell my stock if it falls to 80 or less. The $80 price is known as the trigger price. Well, if we entered an order to sell 100 ABC at a limit price of 80, would that do the trick for us in that situation? Well, it turns out it wouldn't, because think about what sell 100 ABC at 80 means. It says, sell my 100 ABC at 80 or higher. If we just purchase the stock at 86, it already satisfies this condition, and our stock will be sold immediately. So a sell limit order is not what we want right now. It just doesn't do the right job. So to get our order to work properly, we must add a qualifier, the word stop. Now, this order works a little bit differently. Let's take a look at an example to illustrate what stop means and how it works. It says, sell the stock for me if it falls to 80 or less. So let's say a series of trades occurs after we enter this order. Now remember that the stock has originally higher and now it's falling. Nothing happens, remember, until the stock falls to 80 or less. But this is still too high and this is still too high. But notice that we do have a price at $79.88, a price that is less than 80. This price triggered our order, but this is not what our stock was sold for. This is a transaction that occurred between other investors. This is simply a sign to our broker that we should now enter the order to sell our stock at whatever we can get. So now what will happen is our order will be executed on the next available trade, which will be $79.50. This will be called the execution price. Now notice that it really didn't matter what the next price was after the trigger price. It could have been anything. For example, if that price after the trigger had gone up to $80.13 instead of falling, we would have still received an execution. So another way to think about what this means is to say that a stop order, once it's triggered, becomes a market order. Now, from this example, we can see that one use of a stop order is as a defensive order. That is, you have an investment in a stock right now. You hope it makes you some money, but you could receive some losses. So by putting on a stop order, you have sort of a safety net underneath the current value of your stock. If the stock falls, then your stock will be sold before your losses become too large. But notice that it doesn't prevent you from losing money. It only tries to protect you from too great a loss. A stop order can be used for other purposes as well. For example, we can use a stop order to protect a profit in addition to trying to limit our losses. So let's take a look at an example of how that might work. Now, suppose we take our previous example. Now remember that we're long 100 ABC at 86. And we had entered an order to sell at 80 stop as a safety net in order to prevent too great a loss. But let's assume that instead of going down, the stock actually went up. It's up to 104. So now we have a nice paper profit right now, although we haven't sold our stock yet. Now we no longer really need to worry about the stock falling below 80, so in fact we can probably cancel our previous stop order. But what we might do instead is enter another sell order at 100 instead. How would this order help us? Well, again, what it says is sell the stock if it falls to 100 or less. So if our stock, which is now at 104, does start to fall, then the stock will be sold somewhere around $100, and at least we will have retained some of our paper profit at that point. So this does help protect us if we have a profit on paper from losses that might occur or reductions of profit that might occur if the stock falls. So where does the sell stop order then fit into our order diagram? Now remember, a sell stop is triggered when the market falls, so we would say that a sell stop is entered below that market. Now so far we have two types of limit orders and only one type of stop order. And recall, in our diagram we still have one quadrant that's left unfilled. So it would seem that it would be filled by what we call a buy stop order. Now if we think about where that would fit into our diagram, the buy stop seems to be saying, buy the stock for me if it rises because it is above the market, the only spot left in our diagram. That seems kind of puzzling at first. Why would someone wait until the stock rose to buy it? Well, a buy stop, like a sell stop, can be used as a defensive order, as a form of protection. Well, who wants protection against a rising market? Well, there is an investor who does have a problem with the stock going up, and that is the short seller. Now, we'll review the short sale here briefly, and we'll talk about it in more detail in one of our later programs on margin accounts. But here, we want to recognize that a short seller is a person who borrows stock and then sells it, receiving cash from the sale. But because they borrowed the stock, they must return it at some later time. They hope the stock falls so that they can replace the borrowed stock with cheaper stock and take the difference in profit. Their danger is that if the stock rises, they would have to buy it back at a higher price and losses could occur. So let's suppose that an investor has done one of these short sales. Now we're going to sell short 100 shares of EFG stock at 45. So remember that we're hoping that the stock will fall in order for us to make money. The problem is that the stock might go up and we'll have a loss. The higher the stock price, the greater the loss. And notice there is no ceiling to limit the losses that we might suffer. So this might seem to be the place where we would want some protection, and as it turns out, this is what a buy stop will do. So to limit the loss, the investor might enter a buy stop order, let's say at 50. But how would that help? Well, suppose now that the following series of transactions occur. We had a series of trades occurring in the market starting at 45 and rising. Now remember that this series of events isn't looking very good to us because the stock is going up and we're starting to see losses in our position. We want some protection and we're thinking maybe we should get out of this before it's too late. So what will happen is that nothing will occur with our order until the stock hits 50 or higher. Now that does happen at 50.25. Now again, since this is a stop order, this event is called the trigger. Now, this is not what our stock is purchased for to cover our short position. Again, we get the next available transaction, which will be 50.38. Now, this will be the execution price. Again, this execution price could have been higher or lower than the price we see here. The price doesn't really matter for the execution. It's the next price after the triggering event occurs. So the buy-stop order then fits into the remaining quadrant of our diagram. The buy-stop order is triggered when the market rises. So we'd say that a buy-stop order is above the market. So it is likely that you will have to deal with several of these kinds of problems. The diagram can help you because it can tell you what direction the market must move before the order that you're dealing with can be executed. Now remember that stop orders are really a two-part transaction where you get a trigger event first and then we get an execution where for us with a limit order, as soon as a transaction occurs that meets our limit conditions, we get an execution on our order. Now our discussion of orders in the market was a good illustration of how stock exchanges work, how specialists work, what occurs on the book of the specialist. So a lot of this occurred in our discussion of exchanges. But of course, stocks can trade on an exchange like the NYSE only if they're listed there and they've been admitted to trading privileges. But many stocks are not listed. Thousands of stocks, in fact, are not listed. So how do we buy and sell those stocks? Well, they trade in the over-the-counter market. Now, by default, over-the-counter means any transaction that does not occur on a stock exchange. Now, there are a whole variety of transactions that can occur in the OTC market. But we're going to follow through an example of a transaction for a stock that we're going to buy and sell in the OTC market. Many of these stocks are of small companies. So let's take a look at an example of this situation. Suppose that a customer enters an order to buy 100 shares of XYZ, a small local company. The order again is then sent to the order room or the wire room. Now the wire room can be they cannot longer send it to an exchange because it's not a listed stock. So instead we will send it to the firm's over-the-counter or OTC trading desk. Now there can be one or more people working in this area. This is actually a department or room in which people will, using a telecommunications system, find a seller to sell the stock to us. Now what we have to do again is to try to find the seller. Now, how is it that the trading desk is any better than some individual to find someone who will sell the stock to us? Well, it turns out that they know that in the market there are other broker-dealers who are ready to buy or sell our particular stock. Remember that we call those broker-dealers market makers. And so there are a whole bunch of market makers out there ready to do a deal with us. The problem is, how do we find those market makers? Well, it turns out that for many OTC stocks, there is a publication that comes out weekly that a trading desk would use and look at, and it's called the Pink Sheets. In fact, as the name indicates, it is a long pink sheet of paper where we can find many of the over-the-counter stocks listed, and then next to the name are phone numbers for the market makers who are trading that particular security. So this is important and helps us to find the market makers out there in the market. So once we find the market makers, what happens next? Well, we just pick up the phone, call that market maker, and of course, what we want to know is, what's the price right now? So we would ask the market maker for their quote on that particular security. So we're going to look at an example here that happens on our XYZ stock. We've looked in the pink sheets and found 3 market makers listed. So we're going to call market maker A and ask for their quote. Let's say it's 33.15 to 33.75. Now let's remember what that means. Market maker A is saying that I will buy stock from a broker-dealer at 33.15 and I will sell stock at 33.75. And of course, since we're interested in buying stock for our customers, we're interested in the asked price of the market maker. Now, there's only one price though. This market maker has said that they are willing to sell a stock at 33.75, but remember that there are other market makers there as well. It's kind of like shopping for a car. You wouldn't just buy the first car that you saw, you would shop around. So that's what we'll do here. Now we're going to contact market maker B and ask them for a quote. They tell us they're willing to buy stock at 33 and sell stock at 33.65. As well, we're going to contact market maker C, who gives us our final quote of 33.25 to 33.88. We now have to decide who we're going to buy stock from. But remember, since we're trying to buy stock, we're interested in the asked price of the various market makers, and of course we want the best deal possible, and so to buy the stock at the lowest asked price available. So in this particular example, that would be 33.65 as the lowest asked price. On the other hand, if you were trying to sell stock, You would be selling at the bid price of these market makers, and of course you would want to sell for as much as you can, and therefore the best bid price would be the highest bid price, and that would be market maker C at $33.25. So these are really the only two prices that matter to us, the highest bid and the lowest asking price, and so we refer to these as the inside market for the stock. Now, once we know what the inside market is, of course the next thing we want to do is actually complete the deal, and here is where that telephone will come in handy. Now, we have to call that market maker and arrange for the transaction. So remember, it was market maker B that we're willing to sell the stock at. They said $33.65. So we pick up the phone and call market maker B and then say, I'll take 100 at $33.65. They just said that the price had changed to $33.88. Well, what's going on? We heard a quote at $33.65 and now they're telling us that it's $33.88. Well, this illustrates a problem that occurs in trading in this type of market. The price that you get from the market maker while talking to them on the phone is called the firm quote. They have to stand behind it for at least 1 unit of trading on a buy or sell. But as soon as we hang up the phone and check out current information, that market maker can change their quote at that point to meet the current market conditions. So how do we know that they're still getting the best price? Originally, market maker B did have the best price. Now they've changed it. Should we call back all the other market makers and see if they're now offering a better deal? Well, you can see that we could go around and around in this process and never be sure that we did get the best deal. Now, customers wouldn't have very much confidence that if we executed an order for them that they received the best deal possible. So to give investors more confidence in this OTC market, we need to develop a way to receive more reliable information about quotes that are currently in the market and what the best price may be. Well, in fact, the regulator for this particular market, the NASD, has created a computerized informational system that displays the quotes of each market maker registered in that security. These quotes, while they're on the screen, are firm. So now if I call market maker B and say, I'll take 100 of that particular stock, they must sell it to me at that price. That's a firm quote. The system also determines the highest bid and lowest offer and displays it automatically on the screen. And that's particularly helpful when you, say, have a dozen market makers and you don't want to do this manually. So this system, which was created by the NASD, is known as the NASDAQ system, the NASD's automated quotation system. Now, this system is a service provided to members of the NASD, and of course, you do have to pay for this service. And of course, different people within the firm will have different needs for different services. Some people will have greater needs than what is shown here, and some people will have fewer. So there are different levels of service available. For example, the screen that you're looking at here, which contains the inside market, the names and quotes of all the registered market makers, would be called Level 2. Persons at the trading desk attempting to execute transactions would use this. They need to know who has these quotes and whom to call to do a trade. Now, the registered reps that are actually out there dealing with clients and passing orders onto the trading desk don't really need all this information since they're not going to execute transactions. They usually just want to know the inside market, what's the best bid and offer available, and this would be called Level 1 to be used by registered representatives. Finally, some broker-dealers need even greater capabilities than those used by Level 2, the level used by traders. This higher level of service would show not only what is used by Level 2, but also has a keyboard in which these quotes can be changed on the screen. So this is Level 3, and it will be used by the market makers that actually display the quotes on the screen. So in our example, broker-dealers A, B, and C would have Level 3 screens for XYZ stock. Now we have focused a lot on trading on stocks, and we do have to understand how both the pink sheet market and the NASDAQ market works. But we want to point out that it is only one small part of the OTC market. There are many other types of securities that are traded over the counter, and they include, as we mentioned, unlisted securities, which cannot trade on an exchange, government and agency bonds, which are an enormous market, municipal bonds that, again, we'll discuss in detail in a later program. Most corporate bonds trade OTC, even those that are listed on an exchange. Partnerships also trade over the counter for the most part. Now, listed stocks may also be traded under this particular arrangement. Now, why do we have those included there? Don't listed stocks usually trade on an exchange? Well, of course they can because they're listed, but there is no rule to prevent a listed stock from also trading in the OTC market. It is permissible to do that. When that occurs, a listed stock trades OTC rather than on the exchange. That's called a third market trade. Now, we mentioned earlier that most investors use a broker-dealer to represent them in the secondary market. However, there are occasions where investors will trade directly with an investor without using the services of a broker-dealer. These are usually institutional investors with large amounts of securities to buy and sell. So when we have this type of transaction, this constitutes what we call the fourth market, an institution-to-institution trade with no broker-dealer intermediary. Now, trading in the OTC and on stock exchanges is, again, secondary market trading that is regulated not by the Securities Act of 1933, but by a separate federal regulation. The 33 Act only covers the primary market. The secondary market is covered by the Securities Exchange Act of 1934. So under this particular rule, when transactions occur on stock exchanges or in the OTC, those markets, of course, have to be fair. The transactions have to be fair both for the broker-dealers involved and for the customers involved. In addition to federal rules covering the market, that self-regulatory agencies like the NASD and the NYSE also have rules as to their own members, how they treat one another and how they treat their customers fairly. One place where these rules are of concern to a registered rep is where you have the first contact with the customer. Suppose you have a potential customer who wants to open an account with you. Well, both the rules of the SEC and the self-regulatory organizations cover that situation. So when you open an account for a customer, certain procedures have to be followed. Now, we're going to discuss certain procedures for opening what we call a cash account. This is an account in which orders placed by the customer will be paid in full by the customer within a certain amount of time. To open such an account, we first have to obtain some basic information about the customer. And this information is obtained on a new account form. Now, these types of forms vary from firm to firm in terms of the information that is listed, but all of these forms have several items in common. And one way to think about what the basic requirements would be is to think about the principle of know your customer. That is, if I'm going to do a transaction for my customer, I have to know enough about my customer to know whether my transaction fits their investment plan and investment strategies. So we're talking to our customer, collecting all this information from our customer in order to find out what they need and what they want as an investment. Now, once the rep has obtained the info on the new account form, the rep has to sign the account form, and this is the person responsible for opening the account. The rep then has to take the form to a branch manager or principal who also has to approve the account in writing. Now, a principal is a person who has passed a specific supervisory exam that allows the supervision of the activities of registered representatives. So you have to take that account to the person who is in charge of your office, and they have to sign off on the account form before the broker-dealer officially accepts it. At that point, we normally could go on and execute transactions for our customers. However, some customers like other people to do trades for them as well. We refer to these as discretionary accounts. For example, a customer may want a friend, an investment advisor, or even their registered representative to do trades that they think are appropriate. Now, in addition to the new account form for discretionary accounts, we need another form called the Discretionary Account Authorization, or Power of Attorney. This must be signed by the customer and allows the third party to trade on the account. In addition, the firm has to accept it, and that's done by a principal also by signing the discretionary account form. The discretion is not official until the principal has signed off on the form. Now, once the proper documentation has been filled out, then the account is considered open. And at that point, we could accept an order from the customer and enter the order for execution. Now, the order from the customer that would be entered would be written down on an order ticket. A written order ticket is required for each transaction that a firm does for a customer. And of course, this is to protect both the customer and the broker-dealer. We want to know all the details of the trade. Once the order ticket is filled out, of course, we send it to the appropriate department for execution, and in most firms that is called the wire room. Now, this ticket is an important document, not just for getting the order executed, but it's also important for supervisory purposes. The principal, remember the supervisor in the office, is eventually going to examine this ticket, not necessarily before the transaction is executed, but at some time, because the principal wants to make sure that the transactions that we do for a customer are suitable And that means that we have to make sure that the trade we do fits with the customer's objectives. Now, in reviewing the trade to make sure that they are suitable for customers, there is one practice in particular that the broker-dealer is concerned about, and that practice is called churning. Now, churning occurs when trades are done in an account that are excessive in size or frequency in relationship to that customer's objectives. And typically, that might happen because a registered rep is trying to generate extra commission dollars by doing too many trades in an account. So principals have to watch out for that situation. Now, the other practice that principals have to watch out for is the use of inside information. Now, this is a particularly serious violation, not just of industry rules, but the rules of the SEC. So it's important for us to understand a few things about this feature. Insider trading is the use of material, non-public information. Now, what does that mean? Well, material information is relevant to the value of the stock, meaning that if the public knew it, it would change the value of the stock. But it is non-public, meaning it is confidential right now and not commonly known in the market. So if you use this information, it can result in a violation. Now, another place where we can run into this type of problem would be someone who has inside information. They don't use it themselves, but instead they just pass the information along to another investor who does use it. So the person who gave the information is called the tipper, and the receiver of that information is called the tippee. So both of those people are liable, not just the one who made the profit. And to prevent these types of problems, broker-dealers are obligated to supervise not only their customer accounts, but also their registered representatives to prevent the use of inside information. And of course, the penalties can be very severe. For example, the SEC can issue what is called a civil penalty, which can amount to up to 3 times the amount gained or lost in the transaction. And sometimes that's called treble damages. And once the trade has been executed, the customer must receive a written confirmation of the trade. Now, these confirms might look slightly different from firm to firm, but they must all contain the same information, a complete description of what the transaction was, costs involved to the customers, and in particular, some information about how the broker-dealer executed the trade. For example, did the broker-dealer act as the customer's agent, or did the broker-dealer act as a principal for its own account? In general, these confirmations must be sent to the customer at or before the completion of the trade. And what this really means for practical terms is by settlement date. Well, that wraps up our discussion on markets and regulation. And I hope that you'll join me and Pat Laurie for the rest of the Series 7 programs. And remember to contact your local STC branch for help. And if you'd like additional materials, please call 1-800-STC-1223. Thank you from STC.